Back of the napkin underwriting. Really quick disclaimer before I jump into anything. So back of the napkin underwriting, like I said, you can do it in just a couple of minutes. And the reason you can do it in a couple of minutes is because you already know your asset class. So if you are a new investor or a new broker, or you're looking at a new asset, then there's a strong possibility you're not going to understand what the market rents are, what the cap rate is, some basic information. So that the first couple of times that you do your, quick analysis for underwriting, you will need to figure those out so you could hone in on whatever asset you're looking at. So again, that, disclaimer. And we talked about it last week as well, about how Momentum Multifamily, like they had their streamlined process. They had it nailed down. So you knew that they were looking at like 200 plus units. They had Class B, Class A properties. They were looking in suburb markets with, a medium to high income. Like you knew just in the conversations that they were having, they were hyper focused on a very specific, pieces of the multifamily that they were looking at. They weren't just multifamily investors. They were multifamily investors with, XYZ. So I say this because, again, as deals come your way, make sure that they fit within your focus, your box, whatever you're looking at, as an investor or a broker. So, and that's what makes it go by quickly. So, all right, back in the napkin underwriting. So basically, yes, stop using hours and hours to analyze a property. Like me, I've done that. I've second guessed myself 1,000 times and spent way too long on a deal when you just need to know your numbers and trust your gut in the beginning. So, basically, whether you're working with a client or looking for a new investment, obviously don't spend countless hours. So, this back of the napkin analysis is to help close the gap on a deal and basically just quickly shed some light on the property to see if it's worth your time. So this analyzing isn't to then be able to go ahead and submit an LOI. So this is just so you can quickly run the numbers and say, yes, this makes sense. Now I'm going to plug in all the numbers and I'm going to take a deeper look, and I'm going to, possibly start connecting to my third parties and doing like a true deeper dive on this property. And again, I already talked about this, making sure you're analyzing a property that aligns with your portfolio goals. Okay, so like I said, your asset, you already should have the basics of this information. If you don't, then the first time will take you a little bit longer than normal. And we're going to kind of break it down a little bit. So operating income for any of you, operating income is going to be, you take the number of units of the property and you multiply it by market rents. And then you take that number and you multiply that by 12, and that's going to be your general operating income. If you don't know the number of units and, you don't know the broker, a lot of times you can go on apartments.com. So for any of you guys who just, someone maybe verbally told you about a deal or something like that, you can find some general information on apartments.com or the apartments website or storage facility or whatever asset it is. So when you look at the website or go to apartments.com, usually it'll tell you rented and quote unquote sold units. So you can get an idea of how many units the property has, or go to the website, and then it will also show you market rents. And so you can do that, find that quick income right away. I have on here market rents and pro forma rents. So when you're doing this analysis, I want you to do both, because in this market, the sellers and buyers have such a wide gap between, what they're trying to sell it for and what buyers are willing to pay for it. So this is going to give you a really clear idea on a range of opportunity. So, and we'll talk about that a little bit more moving forward. But again, know the market, or if you have an offering memorandum from a broker, which, if you're an investor and you're looking at a property, then you should be getting an offering memorandum from the broker, and they always provide the pro forma rents. Again, this is just a quick and dirty analysis. We know that those numbers aren't 100% accurate, but go ahead and use them for like the first initial underwriting. So right here I have rule of thumb, divide by 90%. So again, we're not going into a deep underwriting, but I always take just a rule of thumb is take your operating income number and you divide it by 90%. And that's just going to at least give you a little gap for like vacancy and economic vacancy. So again, we're just working with rough numbers here to give us an idea. And you'll get to know your industry a little bit better or like your sub-market a little bit better to know if that number needs to go up a little bit higher or lower, but 90% is a good general average. Operating expenses, again, this is particularly for multifamily. Right now, it's actually ranging between 50 and 60% of income. And that's actual income, not vacancy and economic vacancy included. That's the actual total income. And this, again, ranges based off of where the property is located. So some areas are getting really heavy on insurance or taxes. So you could be closer to the 60% range, but 55% of income is a good place. And then to get your NOI, you just take your operating income number, you subtract your operating expenses, and then you have your market one and your pro forma number for your NOI. And I'm going to break this down a little bit. I'm not going to go this quickly. So this is just kind of like what you guys will need and how to just generally get it. To find the value of the property, you're just going to take the NOI that you just calculated and you're going to divide it by the cap rate. As you guys have seen in the last 5 years, the cap rate has changed drastically. Again, I'll kind of show you potentially some places to look at industry standard cap rates for different markets and stuff. Right now I use CoStar. And again, if you're in the markets, you'll know what things are kind of going for. Right now, industry standard is 5.5% in the multifamily sphere. Houston is actually going between the 5 and the 6.1% right now. So again, 5.5 is a good place. If you're in industrial, that's actually higher right now. So just so you know, know your cap rate, because that is going to change your number, and it just depends on which asset you're looking at. So for storage facilities, you're going to be, closer to the 6.5, 7.5 range for this general number right now, depending on your market and your submarket. So breaking it down a little bit, I'm a visual person. So, we went over the operating income. But again, you want to take your market rents and your pro forma rents. And this, again, if you don't have the offering memorandum and you're just kind of new to this, pro forma rents, you can also look at, when you're on apartments.com, you can also look at other apartments that are around your apartment that you're looking at. And so you can look at what their rents are going for. And use those as your pro forma rents if you don't have an offering memorandum. So take those pro forma rents, you multiply that by the amount of units that you have by the 12 months. That's going to get your general operating income. This is the number that you would take your operating expenses from. So this is when you divide by 55% to get your operating expenses. And then you want to take your operating income and you want to divide it by 90%. And again, that's just a general number to include vacancy and economic vacancy. And again, this differentiates between asset classes because there's certain asset classes that have higher vacancy and some that have lower. So again, your NOI is just your net operating income. And so how you're going to get that is you're going to take the numbers that you already figured out, your marketing operating income. You're going to subtract it by your operating expenses and equal your NOI. I will say that on an offering memorandum, and I will pull that up as well, they do, a lot of them do have an NOI and a pro forma NOI. It's still good practice to go through this because sometimes they include or exclude certain things that would skew those numbers a little bit. I don't take what their NOIs are, and I don't take what they're saying that the cap rate is for the properties. So I usually just run them through my own analysis like this. I feel better. I know where I'm coming up with these numbers. And then it just kind of builds that practice. So once you have that figured out, so again, this is why I wanted you guys to figure out the market and the pro forma. So again, depending on the asset that you're looking at, and you're going to know what you're looking for. So if you're looking for like a heavy value add property, and your market value of an asset class, let's say your market value is 3 million and your pro forma is 6 million. Those are the numbers that you came up with. That could seem, vastly different. But maybe it's maybe it's a property that's fairly new. There doesn't have too many things to do to the property, but they've never bumped rents in 4 years or something like that. That would be weird. But that's an opportunity where you don't have to come in with extra capital to then actually get yourself to that pro forma value. And so that number might be farther apart, but to get to that pro forma number, you don't have to do a whole lot or have a ton of transition. And so there could be an opportunity to stay in it. If you're 3 million to 6 million apart and they're asking for 6 million and the market value is 3, and it's a heavy value add, and you're going to have to come in and put $500,000 down on the property to push to fix the units, to get them up to market, to actually get those pro forma numbers. And then you're going to have a high turnover because you are transitioning the units and getting these higher tenants in, so you're going to have a loss during that time as well. And they're asking 6 million and you're at 3, and you're going to be at least $500,000 plus a ton of turnover time, then that number is really far apart. And it's not to me, it's not an opportunity, because they're wanting that pro forma. They're wanting to make the money without putting in that additional CapEx or risk to get that number. But they're wanting to capitalize on, your work to get to that point. So hopefully that makes sense. Basically, so, if your market value is 3 million and your pro forma is 4 million, and all you have to do is kind of bump a couple of rents here and there, that's a strong negotiation situation right there, where it makes sense to have that conversation, dig a little bit deeper, and kind of see what it takes to either lower operating expenses or get the rents to what they're saying that they can get to. So having that range lets you also know, what is it going to take for me to get up there? Is it worth it? And where is their offer? Are they at the pro forma side or are they at the market value side? So knowing those and knowing the market and knowing kind of, your experience and what you're wanting to do, that really helps that kind of quick snapshot of, yes, this makes sense. We're going to delve deeper. I'm going to start, plugging in the numbers and calling the lenders, calling the insurance company, and figuring out where I can break these numbers down. Or nope, they want pro forma. They're taking all of the equity, and it's going to take too much to get into it. Plus, if you have to do a ton of renovation and lose rent to do that, you're not into the property, the 6 million as the example. Oh, sorry. You are now in the property like 6.5 to 7 million to get to that pro forma value. So you really want to make sure that you are looking at the money and the risk involved to get to that pro forma number to help either bridge that gap or just completely walk away. Because this is happening a lot. That's why I'm bringing it up. This is really, and it unfortunately is happening a lot in the market right now. And there are a ton of sellers who are willing to negotiate. So it's just seeing that opportunity for you and where you should be, putting your time. So again, basically, you just go through those steps, and this is where you really need to make sure that what you're wanting is what you're wanting and not find that like shiny object. So I put in here, deals come and go. But once you buy, then you have to make your numbers become a reality. So basically your underwriting that you're doing is your map to the success of the property once you close. So I know a lot of investors who they move a ton of numbers around when they're underwriting because they want the deal to happen and they want it to work. So instead of doing a quick analysis, seeing the snapshot and walking away, they do the full underwriting and then you feel committed. You're kind of committed to that. So then you're constantly moving the numbers around to try to make a deal work. And you have to realize that whatever you're plugging into the system has to be something feasible and something you can take action on once you close. It has to become a reality. And sometimes there's a gap there that investors struggle with. So basically, you want to take your time to understand all the numbers on the reports and really understand what numbers you're moving around to make sure that it's feasible in the current marketplace and that you are getting the correct quotes back. So once you've decided that you reviewed it and you're going to keep it, these are just some quick additional steps. So you want to start at that point, verify with third-party estimates. And once you start getting these estimates from third parties, I always get a second or third opinion as well. So when you get the contractor out there, get multiple options. When you have insurance quotes, get multiple options. Cable companies, utilities, all those different places, whatever you can get multiple quotes on. Don't just stick with the one. Stress test is a big one right now. And I know a lot of passive investors are really taking this into consideration. So it really helps that when you do your underwriting and an ROI Muse, it allows you to be able to do your underwriting and then to keep copying it. So you can do multiple different underwritings to compare them to each other. So do a stress test. I know a lot of syndicators, they would look at historical numbers, historical vacancies, historical interest rates, and they would adjust their underwriting to see how it would fare in different times of history. So it's a great thing to either bring back to your clients or your investors to say, hey, like this property, if you bought it in 2008, this property, if you bought it in 2010, like this is what it would look like and this is how it would fare. Or this property in 2020 or whatever. So that really helps with the kind of the confidence going in. And you know that as things go along, you have different strategies in place to work with, with if your exit, if the cap rates completely drop and you go to exit and that wasn't part of the plan, or adjustable rates, with interest, or I know a lot of balloon payments are coming up. And there's just a lot of fees that have been added in the last 4 years. So just to push it through those different stress tests. Another thing I suggest is if you find a partner to work with, it is very helpful to make sure that that partner has not only an investor that possibly has property, but they're an investor who's gone full cycle, meaning that they've purchased the property, they've implemented everything that they've underwritten, and they've done the full exit strategy, with their investors or however big or small the deal is. And so they've gone full cycle and they've been through both sides of the deal. So